Hello, everybody, and welcome back to Babe, the Bitcoin and Blockchain Evolution. I am Sarah Herring, joined by Matt Davio, and he says Davio. I'm never going to let it go. It's always going to be Davio to me, by the way. But we are joined by Zach Pelka from Paytronage, and we are so lucky to have you on the show, Zach. I've just been checking out some of the stuff you have going on, and it seems like such a cool idea, and especially for someone who is, having a lot of financial debt obligations from my schooling that I'll probably never pay back. Even at 35, I'm like still so far away. I, for one, am very, very excited. So welcome to the show.
Thank you very much. Really appreciate it.
So for those out there,
Zach, you are you're a grad of Wharton, correct, at Penn?
Correct. I actually recently graduated in the class of 2017.
So tell us a little bit about where the idea for Paytronage came from. Obviously, you were at a great school, probably with some really intelligent students and professors around you. What inspired you to come up with this idea? Did you yourself have a lot of debt as you were going through college?
Yeah, sure. So luckily, I actually did not have any debt going through college. My parents were able to really help me out on that side. But I guess to give you sort of the origins of the idea, I was actually working out west at Technology Crossover Ventures, which is a large-scale growth equity firm in which we were basically evaluating investments in huge multi-hundred-million-dollar companies like Facebook, Netflix, Spotify, et cetera. And while working there, basically through the diligence process, quickly realized that the most important element of investing in a company is not really the company itself, but rather the founding team and the entrepreneur himself, which got me thinking, why is there not an investment vehicle to specifically invest into the entrepreneur? So you see for early stage companies, the first company fails, the second company fails, the third one takes off. Why could you not have equity in the entrepreneur rather than that first or second company? Consequently, you could also look to someone like Elon Musk, a Wharton grad as well, where wouldn't you have preferred to invest in Elon Musk, the entrepreneur, rather than just Tesla, just SpaceX, or just PayPal? So that more or less was the foundation of Paytronage, where going through school, I kept thinking about why is this not an asset class? It seems to make so much sense. Companies always focus on the investment in human capital, and this is literally investment into human capital. So why is it not a thing? And as obviously going to Penn, quickly realized that the overall student loan industry is massive. There's $1.5 trillion of outstanding student debt, which is more than 85% of the countries in the world's GDP. And that's just outstanding student debt. And the overall space hasn't really seen disruption outside the likes of the SoFis, the lending clubs, the common bonds, who simply are competing on lowering the overall APR, which is where we really tried to come in and completely disrupt this market by creating a completely new asset class for students.
And that is, the 1.5 trillion, in my opinion, will never be paid back, just like the 21 or so trillion in national debt. So tell us a little bit about, the structure of the ISA, because I do believe the concept is fantastic. And I've got 2 kids in college right now, and I've got, 2 more that will be following. So I have a selfish interest in really wanting to understand the process.
Yeah, of course. So at Paytronage, we're obviously creating this marketplace for income share agreements. So income share agreements, or normally called ISAs, are an investment vehicle whereby a student receives upfront capital investment to pay for school in exchange for a set percentage of their yearly income over a fixed period of time. So it really is like an equity investment into an individual student. And there's a lot of different interesting elements of ISAs that are more or less more student friendly than traditional loans. So one being, it has a fixed debt to income ratio. So when you think about traditional loans, they're agnostic to the fact of whether or not you are an investment banker or a teacher. You still have the same monthly payment. And for the majority of the population who's not an investment banker, this is a valuable proposition for them. There's a number of other different things that are very interesting. For example, with an ISA, you know exactly when you're going to be paying off your loan or ISA. So for example, if you have a 7-year contract, you're paying age 22 to 29, and that's it. There is no principal. There is no interest. It's not you are paying this back until you've paid back the full amount, but rather it's the investor is taking a risk, or more or less a bet on you that you're going to outperform whatever your predicted income / payout will be. And there's a number of other protective measures that for students are significantly more flexible. So for example, there's something called a minimum income threshold, whereby if you are making less than 1.5 times the poverty line, or approximately $20,000, you are not legally obligated to pay basically that time period. So rather than paying, say, age 22 to 29, you want to get an MBA when you're 25 to 27. Those 2 years, you have absolutely no financial responsibility to pay, but rather they're just simply tacked on to the back end. So you're paying age 22 to 25, and then age 27 to 31. So it basically has significant amount of flexibility for up to 60 months in which students are not having interest accrue during times in which they can't pay if they want to travel or take care of family, or if it's 2008 and the economy crashes, or if they want to go to grad school. All these different scenarios, basically a student knows exactly when they're going to be paying it off, and if they go into times of hardship, they will not be obligated to pay. Conversely, on the upside, we have protective mechanisms in case someone becomes the next Mark Zuckerberg. So in our platform, more or less, investors would get to set the maximum payback cap. But what we recommend is 3 times the initial investment. So if I give a student $10,000, the maximum he would ever have to pay me back is $30,000. And while this might seem somewhat high, you would have to drastically outperform our underwriting models, as well as basically in the traditional loan hemisphere, for like a 20-year federal loan, on average, people are paying at least 2x. So if you give $10,000, they're at least paying $20,000. So there's a number of different protective mechanisms that protect students both on the downside as well as the upside.
So gross when I just hear you say like how much money. Oh, it's so gross. I hate it. Now, obviously for investors, there are certain occupation types, for example, which there's probably a significantly higher chance that you might be getting your money back, or even more gambly, like tech industries and stuff. Have you seen that, say, for example, people who are getting, like art history degrees and stuff like this probably will have less chance because they probably also are going to make no money?
Sure. So we actually price this into our model, and which is why it's very interesting. It's not like a binary yes, no, but rather the rate that a student receives is what varies, predicated on what your predicted earning paths are going to be. So for example, a Harvard MBA student to receive $10,000 has to give away a very, very small fraction of their future income. Contrast that with, say, like an English major at Tennessee Tech University or something like that. They're going to have to give away a larger portion, say like 3% instead of 1% for that same $10,000. So mathematically, the way that our models are built, every student will be priced in which the investor is more or less hitting their theoretical targeted IRR. But they should be agnostic to the fact of a Harvard student versus a student from Tennessee Tech. And actually, through a number of our conversations with hedge funds, investment banks, and the financial institution, they're actually more interested in kind of these pockets of students you wouldn't think are going to be these massively high earners, because for that same $10,000, you can have a larger portion of the income. So theoretically, the upside could be even larger.
So this is interesting to me, Zach, because you're obviously talking to the money people, as you said, hedge funds, institutional investors, and they're obviously looking for alpha anywhere they can find it today. And stocks, you could argue, are expensive. There may be more upside. So, when you go to a $1 billion plus hedge fund, what are you kind of seeking from them, and how do you go about securing financing from them? And then how do you then kind of develop a portfolio kind of through your underwriting? I'd like to hear a little bit more detail on how that works. Like, again, I'll use 2 of my kids. I've got 2 kids in SoCal universities right now. One's a sophomore, one's a freshman. And then I've got one that will be, looking to attend schools in about a year and a half. So how would I, I'm asking you 3 or 4 questions here, but kind of walk me through that process of how does the hedge fund invest in Paytronage, and what kind of, long-term investment are you seeking from them, obviously, because this is a kind of a annuitized product that you're spreading out. So it has an insurance piece also. So again, I know I asked you a bunch of questions there, but let's kind of get into it a little bit.
Yeah, sure. So I guess what I could explain to you more is basically what patronage in the marketplace itself is. So in the current ISA space, it's very difficult for traditional lenders to basically start offering ISAs. There's a number of regulatory questions surrounding it. There's the full legal contracts. How do you underwrite it? How do you service it, since it's not a traditional loan? And then how do you find students who want the ISAs? So with Paytronage, we're basically creating a centralized marketplace, trying to become like the SoFi or the common bond of the ISA space. Now, on the back end, we see many different potential lending partners who would have interest in basically offering ISAs to students. So I'll walk you through different scenarios. So one is kind of the obvious one, a university, where the University of Pennsylvania might want to set up an investment fund to offer an additional financial aid product to its students. They would target, say, a 0 to 4% IRR, where it's simply viewed as financial aid. In this case, any student who comes onto the Paytronage platform, who more or less goes to the University of Pennsylvania, could qualify for an ISA. Based on that targeted IRR, we would more or less match the student with the university and give them an offer. So that's kind of the basic understanding is one, university. Two, you could look at philanthropy. So for example, the NAACP might want to set up an investment fund to offer a much cheaper college financing option to peoples of color outside of a scholarship. So it's more or less like a subsidized loan, but with an ISA. And in this model, it could create an evergreen fund where, if you think about like the way this would be structured, once a student starts paying back to the fund, that fund continues to grow and grow and grow over time. So we actually modeled out how you can create self-sustaining funds, which are more impactful than like a traditional scholarship for foundations and philanthropies. You could also look to like a Goldman Sachs or an AQR or a Blackstone as a financial institution who might say, we are targeting high achieving Ivy League students who have above a 2250 SAT and a 3.7 GPA, and we want a 15% IRR. So that's another potential investor partner. And then lastly, which I think might actually be the most interesting, is a corporation. So for example, Google could come onto Paytronage, set up an investment portal for all of the PhD computer scientists at Stanford. Best case scenario, they're recruiting straight into Google as their engineers, and they more or less could have forgiveness programs on this income. Worst case scenario, now the engineers at Netflix and Tesla and Amazon have to pay portions of their salary directly to Google, one of their competitors. So this is more or less the way we've envisioned the overall ecosystem developing, with more or less this marketplace structure. Now, this is kind of a longer term development. So what we have been doing in kind of this first version is trying to build out this underlying asset class. So as we know from accredited investors, they would much rather be investing in a larger pool of students to obviously reduce the variability, and it's more predictable on returns. So basically, we're in the process of building out this asset class, specifically University of Pennsylvania and Wharton students, more or less to start, at which we're also in the process of raising our own LP fund from Wharton alumni, different foundations, more or less, who are interested in owning a future portion of these Penn students' income. So we've been having a number of different conversations, from financial institutions to hedge funds to foundations, and everyone is incredibly interested in the asset itself, but the desired returns, the concerns, they all vary based on who the lending partner actually is.
It's so interesting, and I think so exciting. So many things I think are changing in the way that we're looking at, loaning, paying back loans, invoicing. I think, as you know, we focus a lot on blockchain, and it's one of the things I'm most excited about. I hope is that like my nieces get to grow up in a world that's built in a slightly different way, and a more merit-based way, which is obviously one of the things you guys are focused on. But what I think is interesting is, as someone who maybe wasn't struggling as much with paying back their student loans, Matt was asking a little bit about the inspiration. Where did this come from you?
Yeah, I mean, I think that I have always had an inclination to look at kind of different financial products. Working in kind of venture capital on the investment model, it's just human capital is the most interesting investment to me. Simultaneously, while going to University of Pennsylvania, I have had countless friends be cornered into taking jobs that they didn't want simply because of their student loan obligations. So many of my friends are working 100-hour-a-week investment banking jobs where they could be an incredible writer or journalist or be at the Peace Corps or something like that, but because their student loans have been cornered into taking high-paying, low-passion type jobs. Additionally, you could even think of kind of my scenario where I'm an entrepreneur who's making basically nothing living in New York City. If I had student loan obligations, I would not be able to start this company. However, with an ISA, because it is proportional to my income, I would be able to handle it. So I think it provides significantly more flexibility for students to pursue the things that they're interested in and not really worry about like the financial burden of having to go to college.
What have been some of the struggles? I mean, this is something I went to NYU, and just like going to school, for example, and living was extremely difficult. And I struggled with, of course, I had a lot of privatized loans. And so I had to start paying a lot of those back while I was still in school, which I also think is crazy. I love this idea of offering a period of time for someone to sort of get their feet. But for you, as being an entrepreneur and a business starter living in the city, what have been some of the struggles with trying to get this project going? I mean, it's obviously a great idea, but I feel like coming right out of school and having a great idea like this might not always be the easiest route to go.
Oh, definitely. I mean, there's been many, many different struggles in terms of starting. Obviously, the first being cost of living. It is no shocker that New York City is one of the most expensive places on the planet, alongside with sort of Silicon Valley. But with kind of creating a new financial product, we have to be located where the money is, as well as a lot of the top universities are obviously on the East Coast. But different things like having to pay $600 a desk to go to a WeWork just to have a place to work has made it significantly difficult from an operating standpoint of having to raise a lot of equity capital, simply just being able to give ourselves runway in order to like build out this product. And that's something that obviously, because we didn't have student loans, we were thus able to pay ourselves less and actually extend our runway and obviously make this a reality much quicker.
Have you guys considered, Zach, doing any type of coin offering and your own ICO? Has that ever been considered, that you guys would kind of look to the marketplace and say, hey, let's fund this ourselves. Let's not even go to the big guys. Let's kind of start with a bottom-up approach. And is that something that you're looking at?
Yeah, so we've definitely thought about that a significant amount. Our lawyers are some of the top lawyers in the crypto space. We actually have general counsel that just came on full-time. He hated his legal job and had made a lot of money on crypto, and he enjoyed what we were working on. He came on board. So we actually have a lot kind of in the ICO blockchain space around us. We've spoken with a number of kind of software engineers from Consensus, and I guess the way that we've thought about it, that it makes the most sense, at least to start out with, would actually be doing like an LP fund where we're more or less crowdsourcing, doing a Reg D from accredited investors, and more or less have like a patronage token, which would more or less have like a dividend ownership stake in a patronage LP fund, which we would then be the overall general partner of, and then actually controlling the facilitation of funds to students. That being said, right now we have not gone that in depth into that strategy, just because this is already a very technical, unregulated space. We think that opening up to more kind of technical difficulties is something that at the moment we are not going to be pursuing, but very, very interested in going down the ICO route in the future, just because it really is the newest, easiest way of raising capital. And the overall ISA space and sort of the incumbents in the space have found that the capital side has been the larger sticking point kind of to the development of the ISA market.
So you've got a couple things going on here where obviously I would imagine you're kind of building databases of investors and you're building databases of customers, which are both investors, hedge funds, endowments from, Penn, for example, or Harvard, sitting on $29 billion.
Mm-hmm.
These would be fantastic partners for you. So you're trying to, I'm sure, corral them. You get one, you get two, you get three, and the ball starts rolling. But then on the student side, are you getting, because people can sign up. They can go to the Paytronage website and put in their information. Hey, I'm studying finance. I go to this university, or I'm considering going to this university. Are you actually contributing to people that want to use your money today?
So we are waiting basically until roughly May or June when FAFSA is released and students know what their expected family contribution is. So we're going to be going through the traditional certification process that the common bonds, the SoFis, the private lending companies more or less do. So we have been working through the different processes of identifying the best way to certify, like a student actually needs $15,000 to pay for school. So because of that, the funding will not be more or less offered until June. But at that point, we're then going to be doing the traditional disbursement processes of basically giving students the right to that money in August, where we'll be giving it directly to the university, and then following the traditional disbursement processes of university works either one or twice a year, depending on the way each university works. But right now, students can come onto the platform, fill out all of their information, see what their predicted income is, and then basically wait for an ISA offering come June, in which we'll have different capital sources who might be interested in basically offering to that student a specific rate. At which point they would say yes, no. They say yes, then we would facilitate the entire process. And it's as seamless as like a 3-minute application and then saying yes in June.
Is the app being, or do you have, I know you have an online application, but do you have, a simple app that, kids that are looking at this could download? Can you provide some information for the listeners on that?
Yeah, so we have not developed an iOS or Android app yet. That is in the works, but is going to be probably for the next school cycle. If you're interested in obviously going to our site and checking it out, you can go to https://patronage.co to basically learn more about ISAs, income share agreements, why it's better than a loan. You can actually plug in information, compare what an ISA's predicted cost is going to be compared to a Parent Plus loan or a privatized loan based on whatever APR you might want, and then simply go through the investment process, which takes 3 minutes, doesn't affect your FICO score, and basically receive a tangible offer in June.
I mean, the website looks great. So for sure, everybody should be checking it out. If you're not going to college, someone who is going to be soon, or you have a kid or whatever the case may be. But, I think as someone who spends a lot of my time traveling, I think around the world, there's a lot of other systems which, function differently in order to make sure that people are getting a higher education. Is this type of a platform or this type of a system something you've seen anywhere else? Or is this really sort of a completely new idea? Or is it just new to us in Merca?
Yeah, no. So this is actually a normalized investment vehicle in South America. So the biggest ISA player to date in the world is this company called Lumni, which is out of South America. It was founded by Wharton Guy in 2002. Really, really great people. But basically the way they created was having different investment funds that offered ISAs to basically different socially impacted individuals. So people affected by a war or famine or drought or whatever it might be. And they had different investment funds. To date, they have done over 10,000 ISAs. They have had multiple funds close, anywhere from 11 to 15% IRR. So it's been a very competitive asset class itself and has been really normalized in Latin America, specifically for social impact investing. There's programs in Australia. They're starting to develop in Europe. And the US is kind of the last major market that is yet to actually take off. That being said, there's been significant traction with Purdue University being the first major institution to offer ISAs to its students in 2016. They did about $2.2 million of funding in their pilot year. They did about another $5 million last year, and their success has more or less spurred a number of other copycat institutions to start offering ISAs as well. We don't really envision this marketplace developing with universities offering to students, but more so being like the privatized loan market, similar to the SoFis and lending clubs, where it's going to be the hedge funds and financial institutions who are going to be the major source of capital. But there is a huge amount of sort of global precedent for this to be a legitimate normalized investment vehicle. And the Purdue program has been so successful that there are now 2 different federal bills, one in the Senate backed by Todd Young and Marco Rubio, and then a bipartisan bill in the House backed by 8 different Congress members, which would more or less set bounds around ISAs. So sets the minimum income threshold, the maximum payback cap. It would consider it a qualified education loan. ISA companies would not be regulated by the SEC as investing companies. It creates a significant amount of positive traction in the overall ISA space, which has had a number of different financial institutions chomping at the bits, where if this passes alongside the HEA Act, there's going to be a huge inflow of capital into the space.
So one of the things I was wondering, my husband's family, for example, has set up scholarships and these type of things because they have very specific interests, which, you know, they want to push forward into the world. You know, they're very into this sport, or they really care mostly about this subject. And I can see on the website, but I'm interested to hear how you guys have it set up. So say some particular, you know, lender or financial institution is very specifically interested in people who say go to this school, or people who are going to study this particular subject. Are they able to sort of filter out and decide who they want from a specific set of things that they actually care about?
Yeah, exactly. So that's sort of the whole point of creating this marketplace, is we are creating the most seamless, customizable investment process for lenders across the board, because there are so many different reasons why people are investing money in scholarships and student loans and things along these lines. So all an investor has to do is come onto our platform, set up an investment fund, verify that the funds are there, and then basically set their customized materials. So maybe it's where the student goes to school. Maybe it's a GPA cutoff. Maybe it's an SAT cutoff. Maybe they're only wanting to invest in minority students. Maybe they want to be offering ISAs from 7 to 12 years with a maximum payback cap of 2 times. And they want to target a 15% IRR. All of these are different criteria that they can just check boxes, yes or no, what their target return is going to be, what the targeted demographics are going to be. And then when a student goes through the investment process, we more or less have a funnel, which then qualifies them for different funds. So if a student is an African-American student, they qualify for the NAACP fund. The NAACP then gets a huge list of all the students who have applied, who qualify under that criteria, and then say yes, no, if they want to actually give that student the final offer. Now, on the converse side for a student, it creates a more competitive marketplace in which they might be qualifying for several different funds. So a student might qualify for the University of Pennsylvania fund, the NAACP fund, the Goldman Sachs fund, and then maybe Warren Buffett set up his own fund. And all of these basically have different value propositions to a student. They're going to be different ISA rates, different ISA lengths, but also if you think about fundamentally with an ISA, the lender is incentivized to help the student to make more money in their career. So there are a lot of different potential value propositions that each individual lender might offer to a student. And by having this marketplace structure, you create a competitive process where it's aligning lenders with students, which is something that in the current market fundamentally is lacking.
And investors, in many ways, Zach, they can look at this and kind of create their own, here's a small cap. I want to take, like you said, I want to take these kids maybe from lesser known institutions and really take some flyers because I know something about a program that's going on there in aeronautics or something, that's very specific. So it's interesting because they can really kind of gauge, like some of these smaller institutions may become kind of call plays for them where they can buy a lot more for spread their money around versus, just purely investing in Harvard and Ivy League, UPenn type schools. I find you could do a lot of different things, obviously internally, and that's what you're suggesting, is that the investors can kind of come in there and and really formulate different portfolios of who they want to do the ISAs with and what types of students.
Exactly. I mean, it's so interesting if you think about, if you're composing a portfolio of individuals, the ways you could diversify across jobs, across universities, across potentially like their incomes as they exit, their likelihood of getting jobs, what their career paths might look like. There are so many different ways to diversify this asset class, which is already has a much different sort of correlation with traditional markets. So it's a very interesting asset to a lot of investors, which is why we've seen significant sort of inbound interest from across the board foundations to hedge funds.
Now, you might have already touched on this, but this seems like pretty obvious, something just to like throw out there. How do you guys make money? Where's your pocket? Where's your percentage in the deal?
Yeah, sure. So we're following kind of the similar lending marketplace where we're taking an origination fee, and then we're also taking a servicing fee on the back end. So to be more specific, we'll be taking like a 3% origination fee from kind of the student. So if they're taking out, say, $10,000, we would charge them an ISA rate at $10,300. The lender would be giving us $10,300. We would be giving the school $10,000 and be taking that $300 difference. And then the only fee that would be charged to the lender is when a student gives back their monthly payments for 7 to 12 years. Each of those payments, we will be taking 2% of that, more or less just cover the servicing charges. And then the actual lender receives 98% of that income back. So that's our two main kind of monetization schemes at the moment. That being said, we're looking into a number of potential other ways, such as refinancing existing student debt into ISAs, or even there's so many potential ways of kind of adding on different financial products. Specifically when you're looking at the demographic of 19 to 22-year-olds, which is so valuable for the larger financial institutions, just because the customer lifetime value of those individuals.
And I would also imagine, Zach, that the students having kind of this knowledge that the ISA is taken care of, do they receive the money for each year and then they have to reapply, or is it for, once student is admitted, they know that they're going to get the money for the stretch of until graduation? How does it work
so
in that
each
regard?
year? Yeah, sure. So it's each year they're going to have to reapply, similar to with traditional loan space, just because the expected family contribution will change and vary year to year. Additionally, you could think about a student's profile might change year to year. So if you're a sophomore, you think you're going into finance, you might have X predicted income, but then junior year, you declare that you're actually going to be an accounting major, then that's going to be a slightly different career path. And there are many different examples where it's like if a student's GPA drops, or if they change career paths, or maybe they had a killer summer internship. Things like this that through our underwriting models as they develop will dictate what the ISA rate is and slightly change it over time. So because of that, we're going to be pricing it each year for each new ISA. But if a student takes out an ISA, say junior year, and has to give away 2% of their income for $20,000, and they graduate, and rather than going into becoming an investment banker, they become a teacher, it's still going to be 2%. We don't have the ability to change it retroactively, which obviously provides a lot of flexibility for students to pursue career paths where they're not actually getting cornered into going into those high-paying jobs.
One of the most interesting, I think, potential implications of the whole thing is that basically you guys are going to end up with this incredible amount of quote unquote big data on actually like how many people end up doing X thing, or does this career path actually end up making you more money? Or I don't know, I feel like for you guys, you might also someday have a lucrative little vat of info that you could sell to people, which might be worth quite a lot.
Yeah, we 100% agree. Data has been a really big focus on us. basically since we've started, which is a big differentiator across kind of everyone else who's been in the ISA space. We currently have 5 PhD and master's graduates who are in computer science, who have roughly 10 to 15 years of experience each in machine learning, artificial intelligence. We're basically building out our models. We understand that this has so many different practical use cases as this develops over time. Thinking about really being able to go to university and telling them exactly what the ROI is for every student who's going to that university and what specific major they're going into. We're really tying university output to what a student's career path is. And there's so many different ways that this big data can be attributed and used and more or less leveraged into different financial products to more or less pressure universities to actually help students financially in their lifetime. And we've seen so many issues with universities becoming diploma factories, and you've had all of these larger kind of federal regulatory issues with like for-profit schools where is it really worth $50,000 to go get your degree from University of Phoenix? With an ISA, you can come on and literally look at, no, this is not worth it. And as this develops over time, it's going to be much more granular across like, if you're comparing going from University of Texas to University of Oklahoma to Texas A&M, you can see what the specific ROI is if you're an incoming, say, freshman in high school. And this is going to be a portal where you can more or less evaluate the different choices if you're thinking through just a specifically financial mechanism.
Zach, I'm obsessed. Like, I'm so obsessed. Where were you when I was going to college? Like, you were like a baby. I know it's fine, but man, it just sounds amazing. So I know that Matt already threw it out there. We don't want to keep you forever. You've got to enjoy that beautiful, happy hour down in Florida with the fam. But let's make sure we'll of course put everything in the description. We'll throw in some stuff about the website like throughout the interview before we upload it. But talk us through, just again, let the homies know where they can find you and if they should also be following you on social channels.
Yeah, sure. So definitely check out our website. Brand new, just launched last Thursday at https://patronage.co. You can follow me on Twitter at Zach Pelka or add me on LinkedIn if you have any interest in taking out ISAs or any interested in investing in this asset class. We're looking for both sides of the market. So feel free to reach out to me, happy to schedule calls or talk with anyone who just wants to learn more.
And Zach, I could see I could see battles going on between, 2018-19 class, 19-20 class. You're going to, you're definitely going to be rolling out kind of, that's how it's going to work. So, 1 year versus the next year versus the next, you're going to have quite a competition building over time between the different institutions. And I think that will also shed some light, just as you suggested, on which programs are truly best in providing returns for their graduates. So, hey, I welcome all students to go to the Paytronage site, sign up. It's a great alternative, even if you're going through the FAFSA process, as I am right now for next year. I've got to do this every year. Why not, have your kids apply through the Paytronage system? It makes total sense to me.
I'm all about it. Thank you so much. It's been great to have you on. This was Zach Pelka from Paytronage. We'll have all the links in the description for you guys to follow. I'm Sarah Herring. This is Matt Davio. You guys have been with us again on Babe, Bitcoin, and Blockchain Evolution.